Daniel has asked me, what is the safest investment versus risk? Daniel, I can't give you financial advice, mate. I can go through what the stages of investments are. And bearing in mind, I am commercial centric. I have owned a fair amount of residential properties. Also done commercial, I've done development properties, residential developments. I've owned strata units where we've bought blocks of flats or blocks of units. We've strata titled them and we've sold those off. So there's so many different strategies that you can do. And likewise, you can do that in commercial as well. You can buy a multi-tenanted property, you can strata title that property, and you can sell it off in bits and parts if you want to. And that's a pretty good strategy at creating cash flow. But it has to be the right type of asset that you're going to be doing that to. Otherwise, you're just going to find that it's a hornet's nest at the end of the day. And what I mean by that is if you've got little moms and pops, bits and bobs of tenants and you're trying to strata title, it gets a bit tricky. Strata titling is not the cheapest exercise. You've got to deal with council. You've got to go through a building approval and a DA development approval in order to get that strata title to go through. So have a think about that. Always open to chatting to you about it. But with regards stages of investment, let's just have a look at them. And this is purely my own personal point of view. None of the information that I'm giving you is legal advice. So that's a disclaimer. And this is just, what would I do versus everybody's got different opinions. And depending on what your risk factor is, what you want to invest in. So your cheapest and safest investment, obviously, is to leave money in the bank. Okay, so what are you going to earn in the bank? Probably around about 3% right now, maybe 4% if you're really lucky. So that is very low risk, easy access. You go to the bank, push a button, bloop, you got your money. So that is the easiest and the lowest. All right. The next I would say is if you're investing in funds. So in other words, if you have unit shares or you've got funds in REITs, RITS, yep. Real estate investment funds, that's what that is, or in various different investment vehicles, you could be earning between 6 to 9%. How fast can you access that money? It's probably going to take you about, I'm going to guess, between 14 to 30 days to get your money out. And there's a process in order to do that. The next strategy that you can do is, which most Australians do, most of us invest in our own properties. So investing in your own property is low to medium risk. And depending on how involved you get and where your risk factor is, you can make it a little bit more, let's say, edgy, where you're going into higher risk sort of categories on properties where maybe you're doing a development or splitter blocks, or on your own property, adding a granny flat on. I think those type of strategies are very good and can give you very good returns. So that is very much a matter of more responsibility and getting far more involved, and also knowledgeable. You need to be knowledgeable to know how to do that kind of stuff. Please get advice. Then we start moving into high risk sort of strategies, where flipping's higher risk. Okay, so if you're flipping houses, for instance, you'd need to be buying those houses and holding on to them for 12 months, preferably living in them so that you can avoid capital gains tax, CGT. I didn't tell you that. But yes, you can be flipping those properties, and I'm going to say that's probably around about 9 to 15% that you should be getting out of flipping properties, and also very dependent over what period of time and where you are flipping those properties. Okay, I don't know whether I mentioned that medium to low risk, so in other words, buying your own properties and adding value to it, it's probably between 6 to 10% over a short period of time. Obviously, the longer you hang on to that, the better that investment's going to be. Your next strategy would be to be developing, and developing is high risk, it's full time, it's flat out. It's educational. So in other words, you need to know what you're doing. And your risks over there, I would say, I've been speaking to developers today, and in the current market, they've gone from having previously 25 to 30% down to 15%. So over a period of time, they bought the property 4 years ago. They've been trying to get development approvals, building approvals, and there's such a backlog in councils that it's taking that much longer, that they've been sitting on this property for 3 to 4 years, which means that now if they're building, they're only making 15% on it. So very high risk, and yeah, have a think about that. So 15 to 20% on those kind of developments, unless you get lucky. There's also the strategy of flipping and developing. So in other words, buying distressed property, doing a little bit of a development on it, holding on to it for 12 months, and then flipping that property, which is, again, high risk, full-time work. You're going to be hands-on 100%, and over there, I would say that would be your highest return. High risk, high return. Don't kid yourself, guys. If you've got the time to do that, happy days, do it. It's fabulous. It's very invigorating. You'll learn a lot, but if you make mistakes, you're going to burn a lot. Okay, so that's between around about 15 to 30%. High risk, full-time, high return. Another option is to do private lending. So in other words, if you're sitting on a pile of cash and you can do private lending, you can lend that money to a developer, medium to high risk. And again, I'm going to heed caution over here. If you don't know the developer, don't do this. You need to know the developer very well to know that you're going to be getting your money out from them. Developers can go bust. I hear of developers that just make their entities go insolvent, and whoop, they're gone, okay? And they're gone with your chunk of cash as well. So with that sort of thing, usually you're getting paid between 15 to 20%. If you're not getting at least 20%, it's not worth the risk, in my opinion. I'm always going to say that, in my opinion, okay? Another great way of investments is joint ventures. So joint venture with somebody who is knowledgeable, who knows what they're doing, fairly professional at what they're doing, who's been doing it for a long time, who's got runs on the board. And I'd say medium risk, you're looking at around about 15 to 30% returns, depending on what the deal is, depending on what the strategy is, depending on the lifetime of that joint venture as well. I mean, if you're doing a joint venture with a buddy who's maybe a developer who's done a couple of these and knows how to pull this out the bag, then absolutely happy days. If he's got runs on the board, then do it. If you're joint venturing with somebody that you don't know, I have a little adage that I always say: discuss the divorce before you discuss the marriage. So make sure that you are putting paperwork in place, a little bit like the heads of agreement. Make sure you know what happens if things go wrong, if the project doesn't work, if you're not getting the money out of it that you thought you would be getting out. Because the marriage is fantastic, the divorce is bitter. So always discuss all of that, what in the event of this happening, that going wrong, this going bust, market changes, how do we recover, those sort of things. So joint ventures are great, so long as they're structured correctly. And yes, if you have any questions, any further questions, feel free to send them in, and I'll most certainly enjoy addressing them for you. Till then, see ya. Cheers.